most impressive stories on Wall Street. He's the founder and CEO of Citadel. It's one of the largest alternative asset managers and security dealers in the world.
It's been a big month for Citadel's Ken Griffin in real estate, hedge fund manager purchasing another home this week, only the most expensive one ever sold in the U.S., just off of Central Park.
Citadel is among the most successful hedge funds today.
Ken Griffin's $30 billion Citadel gained 19.4% last year. This is beating out a whole host of other of its rivals.
That is about $6.6 billion in profit. At the same time, in 2019, Netflix's total revenue was $6.4 billion. There are many breeds of hedge fund managers. There are the samurais who don't strike often, but rarely miss when they do. There are the machines who ruthlessly dig up any traces of profits, big or small. Ken Griffin is a builder of machines.
So Griffin started as a quant, but he really doesn't care about any particular strategy. All he wanted was to build a financial company that does whatever it takes to make money.
The son of a project manager for General Electric, Griffin had a passion for mathematics and technology.
I was incredibly fortunate. My father was first generation to go to college. He was one of 7. My grandfather worked on the railroads. My parents always placed great importance in education.
In high school, he learned computer programming and got a job for IBM.
We see that Ken Griffin achieved success at a very young age. Just like a lot of tech entrepreneurs, they started learning to code before computers became popular. It was a competitive advantage for people like Ken Griffin at that time.
You know, the thing about people of Bill Gates' generation was that they were getting their 10,000 hours in a discipline before the rest of the world realized that that was the discipline that mattered, right?
Griffin was also a natural entrepreneur. In 1986, while barely an 18-year-old, he came out with the idea of selling educational software to schools. He launched a company called Discovery Educational Systems. A few years later, Griffin sold out his shares and made a tidy sum.
The company is still in business at West Palm Beach today. At this particular point of Ken Griffin's life, we see all the characteristics of a tech entrepreneur. He was smart, he knew how to code, and he came from a wealthy family that gave him a safety net.
Being a smart kid, Griffin never had any doubt about getting into a great college.
My entire professional career working on probability. In the dark ages of using a typewriter, I typed out about 13 different college applications. I'll get into one of them, hopefully the best I can get into.
In college, Griffin just chose to pursue whatever interested him the most. After reading an article arguing that the shares of Home Shopping Network were overpriced, he purchased put options on the stock, hoping to profit from the decline. Options are derivative contracts that behave like insurance policies. A call option gives you an insurance to buy stock at a fixed price before a certain date. A put option contract gives you an insurance to sell the stock at a fixed price before a certain date.
Take some time to wrap your head around how options work. But Griffin figured out as a freshman in college that you could short a stock by purchasing a put option.
And I made a few $1,000s, which as a college freshman, that is all the money in the world.
Griffin was hooked. He realized that there's so much more to learn about the derivatives.
I used to walk across the river to Harvard Business School where I'd spend hours in the library reading books on derivatives and trying to understand the pricing and financial theory behind derivatives.
He then came across a book that completely changed his life. This book is called Beat the Market, written by quant legend Edward Thorp.
Ed Thorp is perhaps the very first well-known quant. To give you an idea of his influence, he invented card counting and blackjack.
After figuring out you could use probability theory to beat the dealers at casinos, it quickly became obvious to Thorp that you could do the same to the financial market.
He independently discovered the Black-Scholes model perhaps before even the authors did.
Well, I had come across on my own a formula that became famous quite later, the so-called Black-Scholes formula, and I had come across it by a rather different methodology. I didn't have as tight a proof as they did, but I knew it was right, and my method was really strong. So I was able to solve all kinds of problems in derivatives and derivative hedging before Wall Street could solve them.
Using his pricing model, Ken Griffin discovered that there are many mispricing opportunities with convertible bonds.
You're buying a convertible bond and you're shorting the company's stock against it to try to create an equal return whether the stock goes up or the stock goes down. Then one of the nice parts about it is as the stock continues to climb, your sensitivity, or what's often called delta, of the convertible tends to rise with it.
The key is to have a proper pricing model for the convertible bond. Being a proficient coder, Ken Griffin wrote a software program to flag mispriced bonds. To get more up-to-date information, he installed a satellite dish on top of the dorm.
The supervisor of the building gave me permission to put a satellite dish on top of the building so that I could have real-time stock quotes.
Griffin was definitely a smart kid in college, but he also had an incredible amount of good luck. And this is how he found his first investment.
Griffin was passionately explaining his trading strategy to his friend in college. A wealthy retiree overheard their conversation and immediately decided to give him $50,000 for investment. In the summer between freshman and sophomore year, Ken Griffin raised $265,000 from relatives and friends to start his very first hedge fund, called Convertible Hedge Fund. His strategy was similar to Thorpe's Delta hedging strategy. Delta is the relationship between a change of price of a derivative and its underlying asset. For a put option, when the asset goes up in price, the price of the put goes down. The delta tells you how much it changes. Beginning sophomore year, Griffin quickly started his investment operation, mostly buying under press warrants and hedging the positions by shorting the stocks.
Now, I'm in Boston, I'm a kid in college, I'm pretty resourceful. I called a broker at First Boston to ask for advice on this strategy that I came across. And this gentleman, Doug Snyder, was quite generous with his time. And he said, look, this is really not a strategy that our clients do, but the firm does it with our own money. If this is good enough for the firm's money, this is what I want to do with my money.
This is the year of 1987. For those of you that lived through that time, there was something major happened in that year, the Black Monday.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
Luck, once again, favored Ken Griffin. On October 19, as the stock market crashed, Griffin's short positions hit the jackpot, rising so much higher than the losses on his warrants.
The pros on Wall Street were getting slaughtered, while this kid, running his hedge fund in his dorm room, had come up on top.
Shortly before Griffin graduated from Harvard with a degree in economics, it became obvious to him that he needed to raise more money.
Unlike a typical computer nerd, Ken Griffin was really good at networking.
Raising capital for any investment fund is a hard business of itself. Ken Griffin got access to Frank Mayer, a famous quant investor at that time, also a partner to Ed Thorpe's hedge fund.
Frank was the co-founder of Glenwood Partners based here in our great city. He was also a pioneer investor in hedge funds. And he offered me an opportunity to come to Chicago and to join him at Glenwood. It was a pretty simple proposition. I could manage a small pool of capital for Glenwood. If I did well, I could leave. I could start my own firm, and he'd be my partner in doing so.
Impressed by Griffin's ability, Mayer gave him $1 million to trade. Superseding Mayer's expectations, Griffin posted a whopping 70% return in 1 year.
So Mayer found out that this kid was legit. So he decided to help him set up a real hedge fund. I guess you could say that Ken Griffin didn't really start his hedge fund. It was Mayer and his influence and money that launched Citadel.
By 1990, it was the start of a golden decade for the hedge fund industry. And Ken Griffin, more than anyone, was ready to build the most feared money machine in all of finance. As Citadel grew, Griffin's wealth skyrocketed.
Most of the hedge funds follow a 2-20 fee structure. They take 2% of the asset under management and 20% of the profit. And this is how money managers make money. They either perform very well or raise a lot of money. Sometimes they don't happen at the same time.
You know, to the layman, it's not a paycheck they're getting at the end of the year. It is their cut of the fees based on their ownership in the firm, and also the amount of money they have invested in their funds that is growing or shrinking.
Having more money than virtually anyone, Ken Griffin decided to become the most cliché billionaire.
He marries a beautiful French woman. He spends hundreds of millions of dollars on art collections. And he buys the most expensive real estate in every state he lives in.
Although started as a quant fund, Ken Griffin didn't want to stop there.
Don't focus on just a single investment strategy. Focus on building a firm, a platform that attracts the best and brightest people.
To do that, Griffin was increasingly becoming a ruthless leader. He was a big admirer of Jack Welch, who was known for laying off the bottom 10% of employees.
You evaluate people on one axis on behaviors and one axis on numbers.
This approach is quite different from Jim Simons' management style. Instead of firing 10% of your employees, Jim Simons was able to spot talents early on, nurture them, and let them grow.
Citadel started as a quant fund, but Griffin discovered that there is money to be made in the fundamental trading business.
So the core of our business, our biggest business, is what I refer to as just good old-fashioned stock picking. Single largest driver of revenues at Citadel is our team of 90 equity portfolio managers organized by industry specialty who understand the businesses that they invest in cold.
They do everything. Ken Griffin really built up Citadel as this investment powerhouse. You can imagine it as a gold mining machine that would dig up any trace of gold.
In 2020, Griffin is the 34th richest American, according to Forbes.
But in terms of spending power, I would say Ken Griffin is probably richer than non-hedge fund billionaires because a lot of them have their money tied up in 1 or 2 stocks. People like Jim Simons and Ken Griffin can put up billions of dollars of cash very quickly.
With all the success and good luck, Griffin still had his struggles. In 2008, Citadel almost went under.
I'll make it very clear. I would go home on a Friday. If Morgan Stanley did not open for business on Monday, I would be done by Wednesday. And if you remember Morgan Stanley, the question was, would the Japanese follow through on their financing commitment, and their very existence was in question. So you quickly come to terms with the fact that we may not survive.
One common factor I found among the successful hedge fund managers, besides being incredibly smart, they have about the strongest willpower that you can find in human beings.
That's the one thing we really seek out. Because I'll tell you what, determination and persistence almost always wins the day.